Hi class. In this video we're going to look at some examples from chapter 7. So I just wanted to touch on a few of these. In this particular one it says Elegant Gardens, a wholesale firm, made sales using the following list price and trade discounts. What amount will be recorded in each sale in the sales journal? So these are fairly easy, but we just have to know the trick to doing them. So number one says there's a list price of $12,500. And you have a discount of 20% and 12%. So you actually have to take these discounts in like a stepwise approach. You can't add the discounts together and do like 20 plus 12 is 32%. That won't come out the same. So you're going to have to do $12,500. Figure out how much the discount is of 20%. So if we take 20% discount off of 12,500, that gives us an amount due of 10,000, and then we're going to take the 12%. So I get 8,800. Let's make sure I did my math right. Yeah. So you're just going to go through that process in 2 and in number 3. Take one discount and then apply the next discount to the first discounted amount. Alright, so let's look at another one. That's one of the easier ones. I'm going to actually work through the last problem, but I wanted to look at this one just because there's a part that's kind of a little tricky. So this says open the general ledger accounts and enter the balance of accounts receivable, record the transactions, total, prove, and rule the sales journal as of July 31st. All that means is the total down here at the bottom. Then you're going to post those to the ledger, so you've got another tab. And then it says what percentage of credit sales were for entertainment items. So let's see. Your credit sales should be your total in accounts receivable debit. So once you get all those posted, that should be your total. So you're figuring out a percentage out of that total amount that's for entertainment items, and I think there's 2. On the 11th, you had a TV. On the 27th, you had home entertainment system. And it looks like the rest is just household items. So those 2, you're going to add up the total of those 2 and take those as a percentage of the accounts receivable, which would be your credit sales. So I just wanted to kind of give you a couple of hints on how to do number 7. We're going to actually look at number 8 and try to work through this one. So we've got Town Center Furniture specializes in modern living room furniture and dining room furniture. They have 8% sales tax. They've got some sales returns and allowances. And we'll have some general ledger accounts, and we've got all these transactions. All right, so it says open the general ledger accounts and enter the balances for February 1st. So we've got, here's their 4 general ledger accounts, and 2 of them already have a balance. I'm in the wrong tab. Let me go back over here to the ledger. All right, so accounts receivable, the balance was 15,436. And sales tax payable 7,150. And that's the only 2 that says they have balances. The other 2 don't give us an amount. So that's requirement 1. Then it says record the transactions in a sales journal and in a general journal. So we've got all these transactions, and we're going to post all of them in the sales journal unless they just won't fit in there. So that's the trick with these special journals. They are customized. Like, for example, this is a sales journal. So this one is customized to record all credit sales all together. So if it's not a credit sale, if it doesn't have a sales credit, a sales tax payable credit, and an accounts receivable debit, then it can't go in here. So the alternative is the general journal. So we're going to do what we can in the sales journal, and if it won't fit here, then it has to go in the general journal. So let's look at the first transaction. Sold a living room sofa for $44.90 plus sales tax of $359.20. And that was on February the 1st. And unfortunately, we got to do some scrolling here. Sales slip 1615. With Sun U. And I think it gave us a couple of amounts. Let's see. Issued sales slip for $44.90 plus sales tax of $359.20. So the amount of the sale was the amount that they paid us for the sofa. We're also going to record the $359.20 as sales tax. And this column is a credit. Sales tax payable is a credit. This is our debit column. Remember, debits always have to equal credits. So, and you can think about this when you go to the store and buy something, you pay for the item plus the sales tax. So that's what we're doing here. We're going to take the amount of the sofa, which was $44.90, and add the $359.20 to it to figure out the total amount that the customer actually owes, which would be $4,849.20. So that's the item plus the sales tax. That's the total amount of their bill. So accounts receivable would be how much, excuse me, how much total they owed. That debit should equal those credits if we've done it right. And let's look at the next one. It's on the 5th. We're selling recliners to Jackal and Moore. And we're just going to fill in what we know. And let's compare and find our amounts. We've again got an amount, the $2,050 is how much the recliners cost, plus they're paying sales tax. So we've got the amount, got the amount of the sale, of the amount of the items, plus the sales tax. So if we add those two together, we'll know how much she actually owes us. So that's what, $2,214, I think. No, goodness, I can't add it all. 164, oh. I also can't use my calculator today. Oh, it is $2,214. All right, so next we've got sold the dining room set to Hazel Tran. It was on the 9th. Fill in your sales slip number, and that was to Hazel. And let's see what the amounts were. The dining room set was $6,250. And we have some sales tax, $500. And those are credits, so we add those two together to get the debit, which would be $6,750. On the 11th, it says accepted a return of one damaged recliner from Jackal and Moore, originally sold on sales slip 1616 on February the 5th. So that's one of these three. We issued a credit memorandum for $702, which includes sales tax of $52. All right, so she's bringing back a recliner. We're giving her a refund. So when we initially recorded this sale, it's here on February the 5th, we debited accounts receivable because she owes us some money, and we credited sales tax payable and sales credit, which is our revenue. So these were our two credits. This is the debit. So if she's going to return part of that, a recliner, to us, we're going to have to take some amount off of this accounts receivable. So if we debited it before, to take it off, we would credit. We're also going to have to reduce the amount of sales tax because we're going to refund her some sales tax. And we're going to have to account for this decrease in the sales amount that we initially recorded. So if we recorded accounts receivable debit and now we need to credit it, and these were credited before, and so we needed some debits to counteract those, none of those accounts with the corresponding debit or credit are in the sales journal. We can't put an accounts receivable credit here because the column is specific to accounts receivable debit. So this transaction will not fit in the sales journal because the columns don't have the right title. So we can't put it here. It's a return, so we're going to have to put it over here in the general journal, which is where transactions fit when they won't go in a special journal. All right, so we already said we're going to give her the correct amount of sales tax that she paid on this. We're going to give it back to her. So we credited sales tax payable when we made the initial sale, so we're going to debit it to undo that part. We also know that she owes us less money now because she returned one of those chairs. And I think it was Jacqueline, right? Yeah. So we initially recorded a debit in accounts receivable. If she's bringing that chair back, we're going to decrease what she owes us, so we're going to credit to decrease the balance in accounts receivable. Now I skipped a line here because this one's the only one that's a little bit different. You'll recall when we first recorded this transaction, when we sold her the chair, we credited sales. So you might think, well, it would make sense to debit sales. In accounting, we actually don't directly debit that account sales when we have a sales return. Instead, we use a contra revenue account called sales returns and allowances. So that just keeps a tally separate of all of the items that are brought back. It gives management some good information about not just, it separates out the sales return so that management can look at that information and know, are we having a lot of things come back? If we are, why are they? Are they defective? Are customers finding a better deal elsewhere and they're bringing our stuff back and going and buying elsewhere? I mean, you can kind of look into sales returns, and it helps us if we have them all in one account. So rather than debit the sales account, we're going to debit the sales return and allowance account. So that was, let's see, on the 11th, it says we issued a credit memo for 702, which includes sales tax of $52. So there's the sales tax going back to Jacqueline. The total amount of the memo is 702, I think. Yes. So that's the amount that we decreased her bill by. So we have to figure out what the sales return allowance is, and that's actually the value of that recliner, which would be the amount we refunded her less the sales tax payable. And it's the amount that it's going to take to bring our debits in balance with our credits. So that looks like it's going to have to be $650 to bring both of our sides into balance with $702. All right, so let's see. Sold the living room table and bookcase to Ann Brown. Issued sales slip 1618 for $92.50 plus sales tax. So we're going to go back over to the sales journal. Whoops. We're just going to pick up where we left off. Let's see, that was to Ann Brown. and $92.50 and $7.40. And so that makes her total amount that she owes us $9,250 plus $740 in tax. She owes us $9,990. I hope, if I did my math right. Let's see, on the 23rd, we sold chairs to Domingo Salas. And let's see what that amount was. $33.50 and $268. Which means that his total amount due is the total of both of those. So that's the amount in his accounts receivable. And looks like that comes to $3,618. All right, on the 25th, we gave Ann Brown an allowance for scratches on her bookcase. We issued another credit memorandum, which included sales tax and the amount for the credit. So that was on the 25th. So that one is another one that will not fit in the sales journal because it doesn't have an accounts receivable debit, a sales tax payable credit, or a sales credit. So we're going to jump back over here to the general journal. We need to go to the second entry. And we're going to refund her some sales tax. So that's one of our debits. We're going to record the sales return and allowance for the allowance that we're giving her for those scratches. And we're going to decrease what she owes us. So that would be accounts receivable, Ann Brown. And let's see how much it was. It was a total of $378, and the sales tax was $28. All right, so that looks like it takes $350 to bring us into balance. And let's see what's happened next. Got 3 more entries that look like they're all have our sales. So on the 27th, we sold a living room sofa to Jose. So we're going to go back over to our sales journal. I think that was on the 27th, wasn't it? Yeah. And let's see, the sales slip was $3,925 plus sales tax of $314. So the total of those two added together, $42.39. And then we have a February 28th. And I believe another February 28th. And that should be the last two. To Mimi and Alan. And we can do both of these in the sales journal because they are both sales on credit. And let's see what kind of amounts we've got up here. $17.50 and sales tax of $140. Which gives us a total that she owes of those two amounts added together. 890, I believe. And let's see, Alan, he owes us $3,600 plus sales tax of $288. So accounts receivable will be the total of those. So that's looks like 3888. All right, I did some of this math in my head, so let's check. Sure I didn't mess anything up. All right, so it looks like our sales journal is complete. Let's check our general journal as well. Looks like everything's right there. We haven't done these last two, and we've done requirement 1, we've done requirement 2. So we're down to requirement 3. It says post the entries from the general journal to the general ledger. All right, so this is usually where students get tripped up, is the posting part. So that says post from the general journal to the ledger. So you're going to start here, and you're going to post each one of these exactly like we've posted in past chapters. So sales tax payable has a debit of $52. And you know, they should have given us a date. We don't have a date in the general journal, but so I have to go up here. That was on the 11th, and the other one was on the 25th, the other entry. So that one's on the 11th. Back over here to the journal, we've got sales returns and allowances of $650. So we're going to find that account. Whoops, that should be a debit. And that was also on the 11th. And then the next one, accounts receivable, is coming down $702. And you know what? I think I put that in the wrong place. That should be sales tax. Sales tax should be debited $52. Let's fix that. All right, so I posted all 3 of the amounts from the general journal for that first transaction. So then on the 25th, I think I said, yeah, on the 25th, we've got the second entry, sales tax payable is debited $28. On February 25th. We got sales returns and allowance debit $350. And we're doing something to accounts receivable. Let's see, accounts receivable, it comes down $378. All right. Then the next thing it says is number 4, total proven rule of the sales journal. I don't actually think we have to do that. I think it did it itself. Yeah. So it totaled everything up itself. So, but that's all that means. So that was step 4. Step 5, it says post the column totals from the sales journal. So we posted the entries in the general journal. Now we have to post these entries in the sales journal. So when we get ready to post the sales journal, you're going to post these columns one at a time. I mean, the whole column together in one entry, because all of these accounts receivable debits, we can post that $37,438.20 in accounts receivable as a debit, because that's what all of these are. So we're going to take that entire amount and post it in our ledger. So $37,438.20. And we post on the last day of the month, because we're doing this monthly. And so that gets that column. The sales tax payable credit, $27.73.20. And again, the last day of the month. And we've got this last column over here. The sales is a credit for $34,665. And that was on the 28th. Let's make sure I got all these posted correctly. I didn't have any typos. So yours should look something like this. And that is step number 5. Step number 6, prepare the heading and revenue section of the firm's income statement for the month ended. So there's your income statement. You've got revenue and then something that happens to give us net sales. So to get those amounts, you're going to have to go to your ledger accounts and look at these. And on your income statements have revenue and expenses. So you're going to have to look at these 4 ledger accounts and pick out revenues or expenses. Accounts receivable is an asset. It does not go on the income statement. Sales tax payable is a liability or a debt. Again, it does not go on the income statement. Sales is a revenue. Revenue accounts do go on the income statement, so you're going to have to do something with this balance here as far as putting it on the income statement. And then sales returns and allowances is not a revenue account. It's actually a contra revenue account. So it also goes on the income statement. This one offsets the sales. So what we can tell from these 2 accounts is that we in total sold $34,665 worth of stuff. That was our total sales. But some people brought some things back. So we actually ended up selling $1,000 less because we had some people who had sales returns or sales allowance for a total of $1,000. So really we only made $33,665 in revenue, because you'll see this one offsets this one. So both of these are going to show up on the income statement. And then the analyze. Based on the beginning balance of the sales tax payable, what was the amount of net sales for January? So we are doing February. The beginning amount here for the sales tax payable was $7,150. So I believe it said that merchandise sales are subject to an 8% sales tax. So you have to do some algebra here. So when we calculate sales tax, we take the total sales times 8%, and that equals the sales tax that's payable. So we know by that we have 3 variables. The sales times the sales tax percent equals the sales tax payable. 2 of those amounts we're given, so we can do some algebra and figure it out. So we need to find the sales amount, so that's the unknown. So we've got sales times 8% equals $7,150. That's the amount of sales tax that we calculated. So if you solve that algebraic equation, you should be able to come up with the total amount of sales. So sales times 8% equals $7,150. Well, if you move the 8% over, then you've got $7,150 divided by 8%. That should give you your total amount of sales. So that's your analyze part. So that kind of should give you some guidance on doing Chapter 7 in the sales ledgers or sales journal. If you have any questions, as always, feel free to let me know and I'll try to help you out.